All right, let's just dive right into this explainer. Today, we're unpacking something genuinely fascinating. We're going to look at the deeply interconnected systems and, frankly, the hidden laws that completely separate your average investor from a true master trader. We'll be exploring mental models, timeless principles, and get this, the literal frequencies that drive financial markets, pulling directly from Constance Brown's incredible insights in The 30-Second Jewel. If you've ever wanted to really understand the why and how behind market movements, and more importantly, how to actually apply these frameworks to your own decision-making, well, you're exactly where you need to be. Let's get into it.
Okay, look at this quote. Experience allows me to see the repeating errors of their day occurring again today. We are on a different stage with different players, but it's the same old story. Now, what's really wild about this insight is that it proves a fundamental law of economics and investing. Human psychology, and by extension market cycles, they just constantly repeat. The fear, the greed, the panic, none of that changes, even if the technology we use to trade does. And you know what? That gives us a massive timeless edge. Because if we know exactly where to look, we can actually anticipate these repeating cycles. It's all about recognizing those same patterns of human behavior, just playing out on a much, much larger scale.
And here is a brilliant illustration of that cause and effect in practice. I mean, look at this. Back in 1836, an Irish bank failure triggered this massive domino effect because of English dependencies, which led straight to massive American bank suspensions. Now, fast forward to the 2008 crisis, or even modern central bank tightening, and we see the exact same chain reaction playing out. A local failure leads directly to a global contraction. So whether we're talking about 1836 or the modern era, the underlying financial machine is behaving the exact same way across continents. Understanding this interconnected cause and effect, that is absolutely crucial. It's really your first major edge in the markets.
So that brings us to our first mental model, the Socratic market model. The main takeaways here are that technical analysis alone doesn't give you absolute proof, it just helps answer market questions. Challenging your assumptions is what prevents false conclusions and emotional errors. Savvy traders use critical reasoning to find true cause and effect. Like the quote says, we are not signal hunters, we are signal utilizers. You take a market signal, question the underlying assumption, gather alternative evidence, and only then do you formulate a logical conclusion.
To really wrap our heads around how to apply this, consider this brilliantly simple pig farm analogy from the source material. Okay, step 1. The EPA threatens to shut down a pig farm because, well, dead fish are suddenly washing up in the river. A novice just assumes, oh, the farm is polluting. But step 2, you apply Socratic questioning. You actually step back and ask where the problem originated and why it's happening right now. And in step 3, you discover there's been a drought. The drought lowered the water levels, which simply concentrated the normal, pre-existing toxins in the river. The farm didn't actually do anything differently. So, step 4, you win the argument by challenging that root assumption. You see, instead of just blindly accepting the initial blame, this Socratic approach forces us to dig down into the true cause and effect.
Bringing this right back to the markets, we can see a pretty stark contrast. On one side, you have the novice trader. They react blindly to technical signals and surface-level news. They see the dead fish, so to speak, and they just panic sell. But on the other side, the Socratic trader stops to question that signal's origin. They cross-reference it with alternative global evidence, they look for the drought. So, the absolute key takeaway here is that if you want to succeed, you have to shift your mindset. You've got to move from being a reactive novice to a Socratic thinker who always asks why before risking a single rupee of capital.
All right, moving from thinking to acting, let's explore our second framework, the Gann Survival Protocol. The core idea here is that capital preservation must always supersede the desire for profits, mainly because emotional interference, the human element, is a trader's greatest vulnerability. You need strict, mechanical rules for leverage, stops, and trends. As the rule goes, when in doubt, get out, and don't get in when in doubt. The framework is simple. Analyze the daily trend, identify confluent zones, allocate a maximum of 10% of your capital, set an unbreakable stop-loss, and execute completely emotionlessly.
Let's look a little closer at Gann's core survival rules. And guys, safety of capital absolutely comes first here. Never average a loss, meaning actually don't throw good money after a bad investment, hoping it miraculously turns around. Never trade more than 10% of your capital on a single idea. Never trade against the trend. The time factor is incredibly important, and margin calls, you cash those out immediately. These are incredibly practical systems. They aren't just polite suggestions. They are rigid, mechanical limits that you absolutely must deploy if you want to protect your capital from inevitable market volatility.
And that brings us to a harsh, but frankly profoundly true statement from Gann. Human element is the greatest weakness.
Look, you can have the absolute best Socratic logic tree in the world, and you can understand market history perfectly. But your own emotions, your fear, your greed, your ego, your hope, they will literally destroy even the best analytical strategy if you leave them unchecked. That right there is exactly why those mechanical rules we just talked about are so utterly essential. They don't just protect your money, they protect you from yourself.
Okay, now let's dive into our final and, frankly, most mind-bending framework, the harmonic market matrix. W.D. Gann realized that market movements aren't random. They are actually governed by mathematical and musical frequencies. Harmonic intervals dictate major price swings, and by applying Fourier analysis to combine fundamental waves with overtones, market cycles actually become predictable. As he said, the great law of vibration is based on like producing like. So the flow goes from universal frequencies to harmonic overtones to mathematical market cycles, which finally gives us identifiable price action.
You might be wondering, where on earth did this knowledge even come from? Well, to build this matrix, Gann's pursuit of knowledge was basically a global expedition. He studied sacred symbols in Masonic lodges in Brooklyn. He researched Rosicrucian geometry in Greece. But fascinatingly, especially for us, he actually traveled to Dwarka in India, absorbing these crucial ancient lessons and connecting deeply with the rich Indian traditions of cosmic cycles and mathematics. He even went on to study numerology and color in the monasteries of Lhasa, Tibet. He took all this ancient wisdom and synthesized it, just to understand the underlying laws of vibration.
So let's look at how this universal geometry actually applies to the numbers. Just like musical notes have overtones, market prices combine fundamental waves with harmonics to create these cyclical patterns. If you look at the top, you see a fundamental frequency. Below that, you've got the overtones. Those are the shorter, faster vibrations. And then at the very bottom, you see the sum of them all. It creates this complex, synthesized wave. This isn't just music theory, guys. This is Fourier analysis, and it maps absolutely perfectly to human behavior in the financial markets. Now, let's take that one step further. Notice how adding specific, odd-numbered harmonic overtones together creates a really specific geometric shape, a square wave, or what looks like a sawtooth wave. Now here is the shocking part. The source material reveals that financial markets track these exact same geometric shapes. I mean, it looks like a jagged mountain range on a stock chart, right? But it's actually pure, predictable, mathematical vibration at work. And if you want proof from the real world, just take a look at this. Tracing the 2018 U.S. 10-year Treasury yields, you can clearly see that exact sawtooth pattern playing out. It perfectly matches the harmonic rhythms mapped out right below it. This literally proves that markets actually vibrate to universal harmonic principles, exactly like sound or light. The money flowing through global systems is following the exact same natural geometry that governs music and physics. It's just wild to think about.
So as we wrap up this explainer today, I really want to leave you with one final, kind of provocative thought to apply to your own investing journey, your own psychology, and your day-to-day decision-making. If the markets truly do vibrate to the exact same universal frequencies as sound, light, and geometry, well, are you merely trading the chart in front of you, or are you actually trading the invisible laws of nature? Take some time to think about what hidden systems are really driving the numbers on your screen. Because once you see it, it changes everything. Thank you so much for exploring this with me today, and I'll catch you in the next one.